Hello everyone, I'm Jerry D'Ambrosio, Manager of Educational Content here with VectorVest, and it's my pleasure to present this week's special presentation. Correctly sizing each position and properly setting the right stop loss are crucial elements to ensure your survival in the stock market. Many times we either put more money into one investment or one trade, or we don't set the proper stop loss. We wind up taking a bigger loss than we should. Eventually, you are going to run into a series of losing trades, what's called a cluster of losing trades, 2, 3, 4, 5, maybe losing trades in a row. And if that continues to happen, if we put too much money into one position or we don't set the right stop loss and take a bigger loss than we should, your portfolio will eventually blow up and it's really hard to dig out of that. So what we want to do is with every investment or trade that we enter into, we want to follow the golden rule of risk management, and that is don't risk or lose any more than 1 to 2% of your overall portfolio value on any one position. Now, I said portfolio value, not account value. You may have $1 million in your account, but you're, say, taking $50,000 of that and investing it into a particular trading system or portfolio. So what we're essentially doing here with this equation is we're solving for S. We're solving for our stop loss percent. I'm going to put some numbers to this equation here, and let's just say we have that $50,000 portfolio. And the intention is for it to be an investment portfolio, maybe a longer term portfolio as opposed to a swing trading portfolio. We want to maintain a 10 stock portfolio. It's an investment portfolio. I think anywhere between 10 and 20 stocks is a good number. When you're trading, that might be a little bit lower, maybe 5 or so. So with a $50,000 portfolio, it's an investment portfolio. I want to maintain 10 positions. I'm going to put $5,000 into each position, and I'm going to make sure that I don't lose any more than 1% of the overall portfolio value, which is 50 grand. 1% of that is 500 on any one position. So $500 risk on a $5,000 investment gives you a 10% stop loss on each position in that portfolio. Very, very simple. The risk is always going to be the same. It's always going to be that 1% of the overall portfolio value. That is a fixed number for each position. The stop loss percent will be determined by how many positions you hold. 10 stocks, $5,000 in each stock gives us a 10% stop loss. So I'm going to go through a couple of examples on how to calculate the stop loss for each individual position, and then after we do that, how to correctly size the position. So I'm going to go open up the VectorVest program. Here we're looking at Schwab. Great company, great stock. Price goes from bottom left to upper right, stays above our stop price the entire time. If I put earnings per share on, beautiful, bottom left to upper right. This is, one of those high relative safety stocks. This is a great long-term investment. This is a stock that's suitable for your retirement portfolio even, okay? So if I wanted to properly size the position according to what my max stop loss might be with this particular stock, how do I do that? Well, a longer term investment, there's really no better guide or no better stop price to use than the VectorVest stop price. It's a 13-week adjusted moving average, and we adjust the moving average for the fundamentals of the company. So I know, because the stop price is rather far away from price for the most part, that I know it's a fundamentally sound company, because what we'll do with that stop price is we'll lower it based on the fundamentals. Good fundamentals will lower the stop price. We want to keep you in a little longer. Poor fundamentals will raise the stop price. We want to get you out a little sooner. So if I was looking to take this trade now or buy this stock, price is currently at about $92. And our stop price, which is a great starting point, is at $83. That actually winds up being a 10% loss. This worked out perfectly, didn't it? So what does that mean? That means if I wanted to buy Schwab now, I know that my starting point or the current stop price is right now 10% below my purchase price, essentially, if we buy it right now, right around $92. That'll wind up being a 10% loss. I can put $5,000 into the position. My risk will only be $500 if I wind up losing that 10%. Now let's say that our stop price was, 12% below the current price or below your purchase price. Well, 12% of your intended $5,000 initial investment is now $600. That's a little bit more than what we wanted to risk. It's not all that much, right? It still falls between the 1% to 2%, but if you wanted to stick to that hard and fast rule, look, I don't want to lose more than 1%, not 0.9%, not 1.1%. I want to stick to that 1% rule. Then in this case, with the 12% max loss, you can't put $5,000 in it. Simple calculation to figure out how much to put in would be, again, your initial risk of $500 divided by the max percent loss of 12% gives you an initial investment of $4,167. And what I'll do is I'll just pull up my calculator here just to show you. Initial risk 500 divided by the max percent loss, let's say it was 12%, that gives us a $4,167 initial investment. So I know we wanted to put $5,000 into the trade, but with this particular investment, we can't. We have to put a little bit less money in so that no one trade will cause our portfolio to blow up. Again, with a $5,000 investment losing 12%, it's still only $600. Your portfolio is not going to blow up if that happens, but the numbers could get larger, meaning your initial risk might be sometimes 15%, maybe even a little bit more than that. So each investment is important. You have to recognize where my purchase price is, where my initial stop is, what percent that is of my initial investment, and then figure out, can I put the $5,000 into the position like I wanted to? Sometimes you can. Sometimes you have to put a little bit less in so that you're abiding by that 1% rule. Okay, let's take a look at another stock here. Here's METC. Now this isn't necessarily a high RS stock, but this might be a stock that you look to put in your swing trading portfolio. Schwab is more of an investment position. Let's say you're managing a swing trading portfolio and you're looking at MATC. Basically, this is the summer of last year. The stock is just pulling back off of a new, looks like 3-month high. Relative timing is really strong. Now it's drifting down a little bit, but it's still above 1. So the stock is in a nice uptrend. The stock actually had a significant increase in price recently here. It did so on really strong volume, so that's encouraging. So the trend is strengthening. However, we're seeing a period of consolidation here, right? Stock is pulling back. That's natural after a really strong, significant up move. What I'm seeing here, I'm going to create an extended line, is a series of lower lows along with a series of lower highs as well. You can see a little channel that's being created here, a little downsloping consolidation period. What I like to see here, and what I am seeing, is lower volume during this little period of consolidation. We're not looking at a mass exodus. We're not looking at a ton of selling pressure here. It's just natural consolidation, natural profit taking after a nice big up move. So if I'm going to look to take this trade, if I'm going to look to put this stock in my swing trading portfolio, what do I look for? Well, I'm going to look for a breakout. This actually is called a bull flag. I'm going to draw another line here, creating the flag pole, and the consolidation period following the substantial up move there is called the flag. What you look for is a breakout above the upper trend line. That is your trigger to enter the trade. If you look to take the trade, you wait for confirmation. Classic breakout pattern here. What I like too is the stock fell and landed at the old high and then retraced from it. It's just a perfect setup. And if you're a swing trader, this is ideally what you want to look for. Buying the dips just a couple of days off of the low there. So you take the trade there on September 23rd. What is the next step? The next step is, where do I get out? Where do I set my stop loss for this stock? Remember, with our swing trading portfolio, let's say we have a $50,000 portfolio. I want to put $10,000 into each position. $10,000 into each position. I want to try to maintain 5. Some traders will even maintain a little bit less than that. But I want to maintain a 5-position portfolio. I actually do that in our swing trading coaching group portfolio. Started with $50,000, maintain a 5-position portfolio. Not many times are we fully invested, but the intent is to put $10,000 into each position. Well, let's stick to the 1% rule. What's 1% of 50,000? It's 500. So if I put $10,000 into this position, I can't risk any more than 500. That's only 5%, right? Well, let's figure this out. I'm going to draw a freehand line because where I want to set my stop, and actually where I have to set my stop for this trade, is right below the swing low. That's just a risk management strategy when you trade bull flags. You put your initial stop right under the low of the consolidation period. Well, I don't want to get too bogged down in the numbers, but let's say your purchase price was a little bit above 1109 because that was your confirmation level. That represents a 15% loss. Okay? Well, I can't take a 15% loss, can I? I can only take a 5% loss because 15% of my intended $10,000 investment is $1,500. That's way more than I can put into this trade. So what do? Well, we know our risk is $500. We divide that by the max percent loss, which is 15%. I can put $3,333 into this trade. It's not what I wanted to initially. I like the setup. I want to profit from the continuation breakout here. I just can't take on the risk that comes with this particular trade. Not to say that you can't take the trade. All you have to do is just put less money in it. You start with roughly a $3,300 investment. As the stock picks up steam, you can always add more to a winning position. When you do that and the stock continues to run, you're continuing to take that initial stop loss and raise it. As price rises, you're going to continue to trail that and protect the money that you are adding to the position, right? You don't want to keep your initial risk in the same spot while continuing to buy more shares at a higher price. You want to raise that stop loss up as you add to a winning position. So your initial investment was $3,300. It wasn't the $10,000 you intended, but you were able to profit on the nice breakout here and continuation. So folks, the math isn't that difficult. Very easy calculation. You just simply take your risk, which is again 1% of your overall portfolio value, divide it by the max percent loss upon entry, and that gives you your initial investment. But we are always going to follow the 1% rule. If you want to be a little bit more aggressive and let's say risk 1.5%, you can do that. Just adjust the numbers. So with a $50,000 portfolio, 1.5% is $750. So that is your fixed risk for each trade that you take. Make sure you understand where your stop loss is supposed to be, and that will easily allow you to calculate your initial investment. Well, folks, I want to thank you for joining me here today. I hope you learned a little something. What I want to leave you with today is a new course that we're offering called Precision Swing Trading. And this is a fantastic course taught by myself, Steve Chappell, and Dr. David Paul, where we teach you some of the things that I actually went through here today. We'll talk more about position sizing in that first module, more on managing risk. Dr. David Paul does a great job with that first module. We then get into different indicators, technical indicators to use in trending and channeling markets. Steve comes in module 4, teaches you about inverse head and shoulders, double tops and bottoms. And then I'll go through some continuation patterns. I talked a little bit about a flag today. We'll go through flags and pennants and rectangles and triangles, and they're fantastic breakout patterns that every trader needs to know. And then finally in module 6, we get into cherry picking some of these candidates, how to set up the trades, how to execute them, how to manage them. Order entry is very important, and then understanding, I can't emphasize this enough, understanding stop losses, where to set the proper stop loss. And what I love about the reversal patterns and continuation patterns that we'll teach you, they have built-in stop losses for each of the patterns. So you'll always know when you take a trade, when you're going to get out of it. I think that's really important. As a couple bonuses, you're going to get 70 days access to VectorVest Premium. This is our real-time data for the U.S. market. It includes Pro Trader. The auto timer includes the Watchdog as well. So if you don't already have VectorVest Premium, your trial will begin on February 15th. I mentioned our swing trading coaching group earlier. What I'm going to do is I'm going to invite you to 6 swing trading coaching group sessions for the duration of the course. We meet every Thursday at 2:30 p.m. Eastern Time, and I manage a swing trading portfolio, real money portfolio that you can either emulate or just kind of follow along with me. It's a fantastic group. We have hundreds of members that are really doing well in the current market. The portfolio that I manage is up about 6%. Well, the market's down double digits over that same time period, so it's doing quite well. The list price for this course is $995. I want to offer a special rate for you folks to hear this weekend, $495. You could just simply go to www.vectorvest.com/PST. Now, the modules that I just went through, they're all pre-recorded, but we will meet live 6 times for mastery support sessions. Those will begin on February 22nd. We review the content of the module, and then we'll look at the current market on each of these days and try to find trading candidates moving forward. We're also going to hold a live bonus module called How to Short Stocks with Confidence. This session will begin at 2 p.m. Eastern Time on Tuesday, April 5th. Thank you, folks, for joining me here today. On behalf of Steve and David, we look forward to working with you. This is a fantastic course that every trader really needs to take. So have a great weekend, everybody, and we'll see everybody soon.
Yeah.